Q1 reality check for capital and risk leaders. What changed this quarter and what didn't? If you listen carefully to Q1 earnings calls, lender commentary, and insurance outlooks, one pattern stood out. There was no retreat. There was recalibration. Markets did not abandon energy transition exposure. They did not reverse electrification. They did not unwind infrastructure bets. They narrowed tolerances. And that distinction matters heading into Q2. Below is what materially shifted this quarter and what proved more durable than headlines suggest. What changed power demand, moved from forecast to constraint? The U.S. Energy Information Administration, EIA, now projects electricity consumption reaching 4,268 billion kilowatt-hours in 2026 and 4,372 billion kilowatt-hours in 2027, extending record highs. At the regional level, PJM's 2026 load forecast shows winter peak demand growing 4.0% annually over the next decade, reaching 204,650 megawatts by 2035-36, nearly 67,000 megawatt of incremental load. Meanwhile, FERC reports more than 10,000 active interconnection requests, representing over 2,000 gigawatts of generation and storage capacity awaiting processing. Demand is accelerating faster than interconnection clearance. That is not a pricing issue. That is a sequencing issue. Capital is rewarding certainty. U.S. energy transition investment reached $378 billion in 2025, up 3.5% year over year, while grid investment rose 9.5% to $115 billion. The composition is the signal. Capital is flowing toward transmission and enabling infrastructure, contracted revenue models, jurisdictions with regulatory clarity. Globally, corporate clean energy PPAs totaled 55.9 gigawatts in 2025, down 10% from the prior year's record. Yet U.S. corporate PPAs hit a record 29.5 gigawatts. Investors did not exit the market, they filtered it. Data infrastructure intensified load pressure. Moody's estimates global data center electricity consumption will reach approximately 600 TWh in 2026. Up from about 525 TWh in 2025, roughly a 14% increase year over year. At the same time, the six largest U.S. hyperscalers are projected to deploy roughly $500 billion in capital expenditures in 2026, rising towards $600 billion in 2027. When that level of capital compresses into constrained grids, infrastructure timelines tighten automatically. No policy change required. Risk costs continued climbing. Aon's 2026 Property and Casualty Market Outlook reports U.S. general liability rates up 5.6% in Q4 2025. Aon projected continued single-digit to low double-digit rate firming into Q1 2026, with some casualty lines approaching high single-digit increases. Commercial auto liability up 9.2%, with further increases expected. Separately, U.S. commercial reconstruction costs rose 4.4% year over year nationally, with several states exceeding 7%. Insurance markets are not broadly spiking, but they are repricing selectively and directionally upward. What didn't change structural energy growth? EIA's projections confirm that electrification, AI infrastructure, and industrial reshoring continue to push aggregate load upward. No plateau, no reversal. Corporate decarbonization direction. The $378 billion deployed in U.S. energy transition investment in 2025 signals continued capital commitment. The pace may shift, the direction remains intact. Disclosure and underwriting scrutiny. Even as regulatory debates evolve, lenders and insurers continue integrating physical climate exposure, energy volatility, supply chain concentration, infrastructure reliability. Transparency expectations did not soften in Q1. The executive implication for Q1 did not disrupt strategy. It compressed margin. Energy is now a timeline risk. Capital is differentiating more aggressively. Insurance costs are trending upward. Infrastructure readiness is gating expansion. The companies most exposed in Q2 will not be those pursuing transition. They will be those assuming 2024 conditions still hold. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.